Hello, everyone. Welcome to today's session on the five-stage revenue recognition process under IFRS 15, which deals with revenue from contract with customers. This accounting standard helps companies to determine when and how they should recognize revenue. Let's go through the five steps of the revenue recognition process in an easy to understand manner. Step 1. Identifying the contract with the customer. A contract is an agreement between two parties that creates enforceable rights and obligations. For IFRS 15 to apply, contract must meet certain conditions. 1. Both the parties must approve the contract. It can either be written, verbal, or implied as per business practices. 2. The rights and obligations of each party should be clear. 3. Payment terms must be identified. 4. Contract should have commercial substance, meaning it impacts the cash flow of the parties. 5. It should be probable that the company will be able to collect the payment. Step 2. Identifying performance obligations. A performance obligation is what the company promises to deliver to the customer. It could be a single product, multiple products, or a bundle of goods and services. A good or service is considered distinct if the customer can benefit from such good or service on its own or when combined with the customer's available resources, and the promise to transfer the good or service is separately identifiable from other goods or services in the contract. For example, a software developer X Limited enters into a contract with customer to transfer a software license, perform installation, and provide software updates and technical support for a period of 5 years. The company sells the license, installation, updates, and technical support separately. Each of these is separately identifiable, and the software is functional without the updates and technical support. On this basis, there are four performance obligations in this contract: 1. Software license, 2. Installation service, 3. Software updates, 4. Technical support. If a product or service is closely linked with others and cannot function independently, then it's combined into a single performance obligation. Step 3. Determining the transaction price. The transaction price is the total amount that the company expects to receive for fulfilling the contract. The effects of some factors are to be considered while determining this transaction price. Let's look at them. 1. Time value of money. If the payment is delayed for a very long period of time, adjustments must be made for the impact of time. 2. Non-cash consideration. If the customer pays with goods or services instead of money, the fair value of that consideration should be included in the transaction price. 3. Variable consideration. Variable considerations like bonuses, rebates, discounts, incentives, performance based payments are recognized when it's likely that there won't be a significant reversal in revenue. It can be measured using either the expected value or single most likely outcome amount. If a vendor expects goods to be returned, no revenue is recognized. Instead, a provision is recognized at the same time as an asset. 4. Consideration payable to the customer. This is generally treated as a reduction in the transaction price and therefore reduces the revenue recognized by the company. However, if the payment to the customer is in exchange for a distinct good or service that the customer provides, it is to be accounted for as a separate purchase and not as a reduction in the transaction price. Step 4. Allocating the transaction price to the performance obligations. Once the total price is determined, it needs to be allocated to each performance obligation under the contract. This is done based on the standalone selling prices of each good or service. If a product is sold separately, its observable price is used. Otherwise, companies estimate the prices using available data. Step 5. Recognizing revenue when the performance obligation is satisfied. Revenue is recognized when a performance obligation is satisfied by transferring the promised goods or service to the customer. A performance obligation is considered satisfied over time if any one of the following criteria are met. 1. The customer benefits from the service as it is happening. 2. The work being done creates or improves an asset which the customer controls during that time. 3. The work doesn't create something that the supplier can use elsewhere, and the supplier has the right to be paid for what they have done so far. Revenue recognized over time is based on the progress towards completion measured using an output or input method. It is to be noted that the revenue can only be recognized if the progress can be reasonably estimated. If there is no reasonable estimate of progress, but costs are expected to be recovered from the customer to the extent incurred, then to such an extent of recovery, revenue can be recognized. A performance obligation that is not satisfied over time is satisfied at a point in time. Revenue should be recognized at the point in time when the customer obtains control of the asset. Some indicators of transfer of control are A. Customer having the obligation to pay for the asset. B. Customer gets the legal title to the asset. C. Entity has transferred the physical possession of the asset. D. Customer owns significant risks and rewards of ownership. E. The customer has accepted the asset. So let's quickly go over the 5 steps once again. First, you start by identifying the contract, making sure there's a valid agreement between the business and the customer. Next, you identify the performance obligations, figuring out what exactly goods or services you're promising to deliver. Then you determine the transaction price, that's how much the customer is going to pay. After that, you allocate the transaction price, assigning the right price to each of the promises you made to deliver. And finally, you recognize revenue. This happens when businesses delivers on its promises either all at once or over a period of time. And now that's a wrap up on the 5 stage revenue recognition process under IFRS 15 explained in simple terms. These steps help businesses report their earnings accurately, giving investors and regulators a clear and transparent view of how the company is generating revenue. Hope you found it useful, and I'll catch you up in the next video. Stay tuned and thanks for watching.